The number of people searching for truck driving jobs on job boards and the rate at which those visitors are converting are at their highest levels on record for Randall Reilly constructed driver recruiting landing pages. There's a new call to end the FET, the over 100-year-old tax levied on the first point of sale on new heavy-duty trucks. Two of the nation's biggest travel centers, Love's and TA, are in for some changes in the near future. And why should we all care about single-family housing? We'll get to all that and more today on the 30-Day Reset. Welcome to the show, everybody. We got a lot to talk about today, including the latest on driver recruiting data, freight numbers, news stories, and our monthly economic update. So let's not waste any time. Let's jump right in with Trucking by the Numbers, brought to you by Stratus Strategize. After January's very low click costs, the CPC increased between 9 and 16% on major advertising channels through the first half of February. And January click costs were so much lower than the other recent results that the search CPC is still on pace to be its second lowest level since May of 2020. And the Facebook CPC is on pace to have its second lowest level since October of 2020. Overall average lead costs in January dropped to the lowest point since July of 2020. February's overall CPL is on pace to tick up around 6%, which would fall right in line with what we expect with seasonal trends. All track driver types are seeing a CPL increase of between 5 and 10% month over month in February, but those lead costs are also the second lowest level for any month in the past 2 years. Average company drivers' cost per hire fell by 35% in January to its lowest level since February of 2021. And while the lead to hire ratio improved by 20% from December, it remains high relative to past performance. These numbers tell us that fleets have fewer open seats to fill, meaning they can be a little bit more selective with who they hire. Average owner-op CPH fell by 40% in January, and that's the second lowest CPH since July of 2020, and it shows that it indeed remains a good time for carriers to partner up with owner-ops as these drivers are currently looking to minimize the risk in the freight market. Trends of recruiting landing pages and multi-carrier applications continue to indicate drivers have high intent in finding new driving jobs, and the conversion rate on those landing pages is at its highest point on record. Comparing January 2023 to January of 2020, there were 74% more people searching for driving jobs. That's an increase of nearly 1.2 million. Over on the freight side of things, the state of trucking points to weaker market conditions for the foreseeable future, and FTR predicts that the conditions will hold steady for the rest of 2023. They also forecast rates in 2023 will be 11.1% lower year over year, with spot rates expected to decline by nearly 19%. Dry van and refrigerated both posted their only second increase of the year. Both segments' rates trail the 5-year average by the most since June of 2020. But those numbers are somewhat skewed due to the very strong rates in mid-February of 2021 and 2022. Spot load activity was down 5.5% as the volume dropped to more than 61% below the same week last year and 37% below the 5-year average. Total broker posted spot market rates edged up by 1 cent per mile, the largest change in any direction in the last 4 weeks. Rates are tracking 19% below the same week of 2022 and 4% below the 5-year average. Now let's get to this month's headlines. There are new calls to repeal the over 100-year-old federal excise tax, or FET, on heavy-duty commercial vehicles. The tax was originally established back in 1917 as a way to help defray costs of World War I. Among those calling for the tax to be repealed are the American Trucking Associations, American Truck Dealers, and the Zero Emissions Transportation Association. The group argues that if the government wants heavy-duty trucks to be cleaner, they should start by repealing the tax. They go on to point out that the FET adds 12% to the cost of a new truck at the first point of sale. This is not the first time that people have called for the end of the tax, as just last year there was a bipartisan effort to repeal the tax and a similar effort the year before that. But so far, no real momentum has been established to move the process forward through the chambers of Congress. Love's Travel Stops are continuing their strategic growth plan and have announced the company plans to open 25 new travel stops, add 30 new restaurants, remodel select existing locations, open 15 Love's Truck Care and Speedco locations, add service and partnerships with top brands, and expand the number of RV hookups. But Love's is not the only travel center in the news. One of the largest travel chains in the country, Travel Centers of America, could be in for a change of ownership. BP has reached an agreement to purchase the chain for $1.3 billion in cash. The acquisition is expected to bring just under 300 Travel Centers of America sites in 44 different states into the BP portfolio. Chairman and President of BP America, Dave Lawler, had this to say: "Subject to approvals, we look forward to welcoming the TA team to BP. TA's amazing nationwide network of on-highway locations, combined with BP's more than 8,000 off-highway locations, have the potential to offer travelers and professional drivers a seamless experience for decades to come." That's it for our top stories. Now let's check in with our good friend Jason Miller for this month's Economic Outlook.
So what we're going to talk about this month is building materials and the housing market. And the reason we're going to do that is no matter what sector of trucking you're in, you are touched by single-family housing activity. Last month when we talked, there had been sort of some positive signs in the December housing data. Well, that got completely erased with revisions, and the January data was equally not inspiring. So what we've got here is an index of single-family housing activity that I create that is essentially the average of the amount of new single-family homes sold as well as new single-family starts. And the base for this is 2019. So 100 equals 2019 here. So what we see is, once COVID hit, much to many people's surprise, as soon as we started to see reopening, housing activity really spiked. So we had a tremendous surge of home sales, and then following that, new housing starts. So housing activity was running, 20 to 40% above where it was in 2019, effectively from June of 2020 through about April of 2022. But then the very sharp rise in mortgage rates caused housing activity to very much slow down. And so we went from this elevated period, 20% above 2019 levels, to in just a few months crashing back to 2019 levels. And that's essentially where we're sitting right now, as we've seen housing activity revert back to where it was in 2019. So when you think about this, this is effectively meaning 20% fewer loads being moved in this sector than what we were seeing just a year ago at this time. We also see I've got Home Depot's days to turn inventory, which is the preferred supply chain metric when we're talking about how fast retailers are churning through their stocks. And we see that series very closely mirrors what the Census Bureau is reporting for the broader sector. Once we had the surge of housing activity, people went to Home Depot, inventories plunged relative to sales. But we've seen this steady increase in days to turn inventory to where in the fourth quarter of 2022, Home Depot's days to turn inventory were 22% higher than they were in 2019. What this means is that we have more inventory relative to sales, which is going to mean muted orders as a company like Home Depot tries to get those stock levels aligned with demand. What's going to make that even more challenging is on the right, I have seasonally and inflation adjusted sales for Home Depot. What we see here is, again, with 2019 as a base, is this explosion that occurs in 2020, especially that second quarter, corresponding perfectly to when inventories get depleted. And then the first quarter of 2021, as we have stimulus money, where Home Depot effectively is selling 20 to 25% more product than they were. So that's 20 to 25% more loads for the largest building material retailer in the country. What we saw, though, in the fourth quarter was a decline of about 5 to 7%, to where activity, while still above where it was in 2019, assuming this inflation adjustment holds for Home Depot. So there still are more loads than there were in 2019 for Home Depot. But again, they're trending down. And with single-family housing activity where it's at, it's difficult to see a case where they start trending up again on a seasonally adjusted basis. The data I'm looking at the most closely as we're trying to understand activity over the next 3 months in trucking is where do we see single-family housing activity move to? Right now, we're not seeing very many positive signals. This is made worse by the fact that the January inflation data was higher than expected, which suggests the Federal Reserve Board may need additional rate hikes beyond those that are anticipated. That means higher mortgages. That means less affordable housing. That translates to less housing activity. So what should you be watching? Housing activity, and the inflation data. If we start to see inflation cooling, that will be a good sign for housing, albeit possibly 6 to even 9 months down the road. So with that, that concludes this monthly update.
And that does it for this edition of the 30-Day Reset. For more on everything we covered today, including all the recruiting data, the news stories, and Jason's economic breakdown, you can download this month's PDF, link found below. If you have any questions or would like to work with our team to reach your goals, you can schedule a free driver recruiting consultation by filling out the form provided below. Come on back and see us next month. Until then, for Randall Reilly, I'm Joshua Miller, and this has been 30-Day Reset.